Are you sure there's nothing better than portfolio theory to decide what to invest in, especially in today's ever greater and ever faster volatility? And if you're a family office or an impact investor, are you happy with the alignment between your intent, your values, and what portfolio theory tells you to invest in? There's no doubt that how we've invested so far has done a superb job for many, but equally true, it has failed for many. What about the future though? How confident are you that the way you have been investing is the best from now on? Pause for a minute to decide on a number representing your confidence, a number between 1, no confidence, and 10, unshakable confidence that there's nothing better than investing in a portfolio of individual companies. Reflect for a moment on your reason for choosing that number. Most of the investors I've talked to choose a number between 3 and 8. They know they're getting neither the reliable impact outcomes nor the reliable investment returns they want. You'll see in a bit that there is a better way to reduce your risk of losing money, increase your chances of profit, and stay aligned with your values. You're probably skeptical right now, and rightly so. You might be thinking, from what you've been told by your family, your professors, by the professionals in your family office, and by your peers, that everything is working just fine, that portfolio theory does deliver the maximum risk-adjusted returns, that you're doing anything else will only end up embarrassing you. I'm confident that there is a better way. It becomes obvious when we debunk 3 specific myths. But before I come to these 3 myths, here are 3 of many examples where this better way has been put in practice. Firstly, this is common in Asia, the Japanese keiretsu, for example, and inside large multinationals like Procter & Gamble or JP Morgan. So we know it works in practice today in mainstream big business across the world. Secondly, traditional economic practices in the world's faiths and indigenous communities, for example, Ubuntu practices in Africa. So we know it has worked across the world for millennia. And thirdly, nature puts this better way into practice in how ecosystems work. So we know it has worked for everything that has been alive for 3.7 billion years. It is in practice in business now, in social traditions for millennia, and since life began. Curious to know what it's called? Wait a bit, because the words are new and the concepts take some grappling with. To take another step on this on-ramp, let's look first at what the common practices are across all 3 examples. Number 1, the ecosystem as a whole is the minimum viable investment arena, not individual entities or species. Number 2, the ecosystem has countercyclic components so that for almost all unpredictable changes that harm one part of the ecosystem, another part benefits. So the ecosystem as a whole flourishes because of unpredictable shocks. Number 3, the ecosystem internally has both high levels of competition and high levels of collaboration. Not either or, but yes and. For example, in my old company, Procter & Gamble, the internal brands compete with each other and collaborate for Procter & Gamble overall to grow. So what are the 3 myths we need to stop believing in because these beliefs are limiting us from putting this better way of investing into practice? First, we need to stop believing that the averages used in business and portfolio planning actually predict typical future outcomes. They do not. Number 2, because of this primary myth, we also believe individual standalone startups or small companies are sufficiently viable to invest in. They are not. And thirdly, because of this, we believe that competition alone is all we need in a market economy. It is not. Now is the best time ever to bravely make epochal changes to our investing paradigm. Today's volatility and polycrisis requires us to use our fear to recognize our limiting beliefs. Challenging as it is to change what we and everyone around us has believed for decades, the risk of refusing to change is now riskier than changing. As a comparison, the winners today are the investors who, 2 decades ago, invested in new paradigm companies like Apple, Sony, Google, not the investors in old paradigm companies like Kodak or Nokia. So too, the winners in 2 decades' time will be those investing according to a new paradigm. Okay, hold tight. Now comes some new words and some new concepts. There's no way in this short video that you'll be able to get immediately a complete understanding of everything that's wrong with portfolio theory and what it is that fixes portfolio theory. That's why I wrote a book on this and run programs for investors. To explain what's possible in this video, this new investment paradigm comes out of a rapidly growing field called ergodicity economics, and so it's called ergodic ecosystem investing. First, I'll show you the difference that it makes in practice, and then I'll explain what ergodic and non-ergodic is, and why portfolio theory is not able to fulfill its promise of maximizing risk-adjusted returns in volatile times. So, to the results in practice. What you're looking at here are the cumulative returns to investors month by month over a 10-year fund. This example is from our investment planning tool and is the outcome of a challenge to 4 different teams of investors to beat us. Each team chose 4 different portfolios of companies, and then our software predicted the returns of the portfolio over 10 years. Those are shown in the dashed lines. We also predicted the returns for the same companies in each case, but instead of using portfolio investing, we used ergodic ecosystem investing. The solid lines show the companies when invested in as an ergodic ecosystem. As you can see, the best portfolio looks better for the first few years, but by about year 5, the ergodic ecosystem investments are consistently outperforming the portfolios because ergodic ecosystem investing better harvests the alpha upside of volatility. More importantly, the risk of making a mistake in the stocks you pick for your portfolio is lower because ergodic ecosystem investing is less sensitive to the downside of volatility. In other words, it is an integral alpha and beta strategy. For impact investors, this is especially powerful because it means you have cash available for impact and still get the same returns. And if you're investing to deliver systemic impact outcomes, ergodic ecosystem investing is inherently superior to portfolio investing. Now I'll talk a bit about what portfolio theory gets wrong. If you want to skip the next 2 minutes, do so. It's a little technical, and I invite you to be patient because there is no easy road to understand this. No easy road to really unlearn everything you've been taught about portfolio theory and economics and replace it with ergodic investing and ergodicity economics. It takes far more than an introductory video can do. For that, go to my book or to one of Evolutesix's investor offerings. So, this might hurt, and there's no Novocaine. Portfolio theory promises you the best route to future returns in a world filled with volatile and unpredictable dynamics affecting capital growth and risk over time. So its core is a statistical formula to predict how the volatility might change the capital of a company over time. Capital here stands for working capital, market cap, or any analogous quantity. Now, volatility either changes capital in a simple way, the green box, or volatility changes capital in a complex way, the red box. There is no other option. For simple volatility, you can predict typical future outcomes using the simple statistics you've learned. These are called ergodic statistics. For complex volatility, to predict typical future outcomes, you must use a fundamentally different kind of statistics that you've probably never heard of, called non-ergodic statistics. It's really important to keep in mind there are no other options. Volatility either obeys ergodic statistics or it does not. And in real life, almost everything obeys non-ergodic statistics, not ergodic. The only time where ergodic statistics is helpful is where the volatility is simple and flat. The problem is portfolio theory uses only ergodic statistics because it's simple and easy to calculate. That means it cannot see red box non-ergodic volatility. Because of this, portfolio investing theory is far from practical. It is irrationally optimistic. It predicts more growth and lower risk than you are typically going to get in the real world. Even worse, the real world is not 50-50 red non-ergodic and green ergodic. The more unpredictable the economy is, the more red box complex non-ergodic volatility you have. And the smaller the companies you're investing in are, the more complex red box non-ergodic volatility you have. Portfolio theory is as practical in today's rapidly changing, unpredictable world as a flat Earth map is to an airline pilot flying from New York to Singapore. Flat Earth navigation is fine for very short distances, but may well get you lost over long distances. Just the same, portfolio theory is fine when the volatility is simple and flat, but is likely to lose your money when the volatility is complex and jagged. This color blindness of portfolio theory is why aligning capital preservation, capital growth, and your family values is becoming more and more challenging for family offices. Because portfolio theory has numerical precision, it gives the illusion of knowledge, but it's actually precisely wrong. It's better to use something that is approximately right because it inherently works with the unknowability of complex systems. Ergodic ecosystem investing does inherently work with the unknowability of complex systems, and it does it because it actively transforms the higher risk, lower returns non-ergodic red box volatility into lower risk, higher returns ergodic green box volatility. That, by the way, is why I called it ergodic investing, because it transforms the volatility from non-ergodic towards ergodic. Whatever you do next, at the very least, only take investment decisions based on the actual non-ergodic red box volatility you're exposed on. Decide based on what is approximately right, not what is precisely wrong. And if you want to do the best you can within your current portfolio, there's a lot you can do without shifting to full ergodic investing. Begin with simply recognizing that portfolio theory's color blindness is a driver of 11 in 12 startups failing and 50% of VC funds delivering less than 1x back to their LPs. If you want to go all the way, the 5 biggest changes for investors are: number 1, invest in an ecosystem as a whole via an ecosystem holding company, systemic investing. Number 2, the ecosystem holding company invests only in the ecosystem member companies. Number 3, the ecosystem is counter-cyclically diverse. For example, it may have fintech, breweries, AI, travel, multiple geographies, and include the vertical supply chains. Number 4, the ecosystem runs capital pools for the ecosystem as a whole to flourish, a double-sided hedging, protecting against black swans and enabling companies to benefit from white swans. Another benefit for you, beyond better outcomes, is that you can engage anywhere you want in the ecosystem, as narrowly or as broadly as suits you, to do what you really enjoy doing. Investing this way, compared to an equivalent portfolio of individual companies, actually makes the ecosystem as a whole less volatile and less complex. It eliminates the deepest root cause of losses in complex volatile systems, losses caused by non-ergodic red box dynamics, so that each dollar invested does more work. You can see this in practice everywhere once you look for it. This is how big companies like Apple, Google, Sony, JP Morgan, etc., with multiple product lines and multiple geographies actually work internally. They are actually a systemic approach to transforming the non-ergodicity of individual brands and countries towards ergodicity for the whole top-level listed company. It's central to the systemic investing we need in order to solve today's biggest challenges and to make good use of today's biggest opportunities. And you've likely experienced this in your life as well. After all, this is how families have always preserved wealth over generations, and it's how to maximally enable all family members to succeed. You work as a family with both high levels of collaboration and enough competition internally, and high levels of pooling of financial and human, etc. capitals. The secrets of ergodic investing are hidden in plain sight, and yet there is nothing more practical to solve today's challenges because it has been proven in modern business over decades, it has been proven in families and cultures since humanity began, and proven in nature for 3.7 billion years.